The repo markets, the negative interest rates, the passive funds, these negative, I call them FTDs, financially transmitted diseases. The average person isn't thinking about gold as a safe haven. So there's a lot of upside here for gold, but I think we're still in early days in the gold bull market.
Please join us for our next live stream Sunday, November 10th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, November 10th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, some housekeeping. If you are new to this channel or you have not already done so, please do subscribe. Click on the bell to be notified on new updates and do give us a thumbs up if you like what we do. Our guest today is Marin Katusa, founder of Katusa Research and manager of the KCR, Katusa KC Rule Fund. Marin is one of the world's leading financiers in the resource space and has led his subscribers and fund investors to several profitable exits in resource assets. We are delighted to have him here today on SBTV. Good day, Marin, and welcome. How are you doing?
Excellent.
Marin, can we start by having you share with us how you got into the resource space and what about it got you interested?
So by luck, I'm born and raised in Vancouver, British Columbia, the province in Canada, and that's really the heart, the epicenter of the financing. I did not grow up in the business. I went through university of my undergrad on an academic scholarship. So, I went towards the sciences. My background was math. And it was actually when I was teaching calculus, one of my students' father asked the question if I could calculate something for him. And he was running a company called Primary Metals. And it was interesting enough, part of the academic scholarship I had, I was forced to take a lot of these credits. And I was always interested in geology. And then, interestingly enough, the professor, the head of the department at the time, was like, "Look, Marin, there's no work in geology. Stick to your math." So I said, okay. And interestingly enough, about 7 or 8 years later, that professor came and worked for me full time. So it's a kind of a complete circle. And that individual who was running the company, I did a ton of research for, and we became very close. His name was Jim Robertson. So he always holds a special place in my life because he kind of made let essentially a nobody in, but he used a lot of my research in tungsten. And I took a big loan, and when you go through the CFA program, you don't learn about warrants or any of that, or private placements, or the way the industry really works. So it was a real eye opener for me, and I got heavily invested in tungsten at the time. And the first 10 months was a very, very shaky. This is not a boom, bought stock at 15 cents with 25-cent warrants, and made a fortune right away. The first 10, 11, 12 months really tested my testicular fortitude, shall you say. And I was down at one point over 50%. And I remember just teaching, thinking, oh my God, if I can just get back to par, I'm done with the stock market game. And little by little, my thesis was going through. And then I found out about this whole newsletter world that I had no idea existed. And people were using my work. A very famous, well-known newsletter writer asked me to be his ghostwriter, and he wanted me to sign all these confidentiality agreements. I'm like, whoa, what's going on here? And I'm just a teacher, it's just a young kid. And then from there, just launched. Then I got into uranium early, partnered up with some great guys and mentors, and then did Quadrilla, Copper Mountain, which became the third largest producer in the country for copper. And I guess the rest is history. Just kind of happened.
Yeah, that's pretty interesting. Someone had some plans for you. Definitely had plans for you. Uh, Marin, what were you doing when the global financial crisis of 2008 struck, and how did it affect your investment portfolio?
It was a big shaker. In 2008, I just churned 30. I was very wealthy on paper, but I didn't convert that wealth on paper into, fiat paper, shall we say. I guess you could say I was land wealthy at one point. I've got this very large parcel of real estate in Europe on the water. I did do that, and then in Vancouver, but I was so heavy invested in these deals, and so many of them went no bid, meaning that even if I wanted to sell, there was nobody there that wanted to buy them. And at the time, I took a very different approach than the rest of my colleagues. I truly believed that, we weren't going to get into some crazy depression where the economy would, as people are saying, copper would go to 50 cents. And I was so heavily invested in copper and lithium and uranium at the time. So I essentially went all in, and I was so into it that was kind of the big success of our first fund. And that's kind of what got me to the next level with the big returns in the fund. I went literally all in. I was one of the largest financiers in late 2008 to say 2010, because I just went full throttle in. And those were some of the biggest gains of my life during that time. So it really solidified being a contrarian. And really getting the best value is when everyone is, financially paralyzed, whether they want to or they're too scared to finance because they think it's going to go lower. But some of these financings we were doing were less than cash in the bank. You get these projects for free. It was just a phenomenal time when you look back at it. But when you're through it, people are so worried. For example, I remember Copper Mountain, a company I was a director and the largest investor in the deal, individual investor. We had $17 million in cash at the time. We were trading at a $12 million market cap, and you got the project at the time. It wasn't producing yet, but it's the third largest producer today for free, plus $5 million in cash. Right? That gives you an example. Something like I was the first guy publishing the cash boxes. At the lows, 1/3 of all the Canadian listed publicly traded exploration companies were trading less than cash. So if you take the market cap and you minus the cash and you add the liabilities, they were still trading under the cash like distribution value, and it was just a phenomenal point, right? So that's a good perspective of where it was versus the peak in 2011, where out of the 2,700 publicly traded companies, I think 4 were trading under cash from 800, and that's when I became very unpopular in the market when I stood up at the big conference and said, the game's over, guys. Everything's going to go down at least 50%. And I took our funds to cash and myself to cash. You have to be a contrarian to succeed in this business.
I hear that a lot when Rick Rule speaks. That's exactly what he says. There have been more and more signs that a repeat of the 2008 crisis could happen soon. A naturally long U.S. business cycle, many measures of debt continue to rise, an overvalued equity market, etc. I mean, we can go on and on. Do you expect another financial crisis to hit the global economy soon?
That's I guess that's the big question everyone's wondering. Let's take Canada, for example. Our real estate is completely out of whack. Their taxing is incredible. It's one of the highest tax nations in the world. Our political system is totally out of whack. It's a minority government, so it's going to be a political stalemate. Industries that actually create wealth, like oil and gas and mining, are looked down upon, and a small NGO activity can bring down $1 billion infrastructure project. And they're promoting these non-value jobs like tourism and things like that. So when you look at someone like Canada, where the provincial deficits are massive, you would expect something to happen. But if you look at the actual banks, if you look at the actual reasons for the last financial crisis, the banks are in a bit better situation in Canada than they were back then. I think the same could be argued in the US. So I think it's going to be a different type of crisis. Will it be because of China or what happens in Europe? I don't know what it will be. But if you look at some of the reasons about the stock market, passive funds weren't a major thing in the last financial crisis. Today, they actually make up over 50% of the volume in the market and the buying, and that trend is not changing. So if you truly think about how the mechanisms of passive funds coming into the market and buying the big stocks, I think we're going to really see a dichotomy of really liquid, big, overvalued, too big to fail stocks, and then everything else. And I think that's kind of going to be the interesting thing in the market. Negative interest rates is going to have a real big implication to the markets, and I don't think people are truly understanding or valuing the situation. And there's such this, specifically in the resource market, the gold bugs. Guys who like to invest in gold think that the U.S. dollar is going to hell. Well, it will eventually, but much after all the other currencies. So I think the U.S. dollar is actually the place to be, and you wouldn't believe how much hate I get for that, but it's treated me very well. And, it still is the king of currencies. I'm a big believer in gold, and I own a lot of gold and gold stocks, but U.S. dollar is still strong to be. So, when you look at the repo markets, the negative interest rates, the passive funds, these negative, I call them FTDs, financially transmitted diseases. There's a lot of, potential black swans, but what happens? It doesn't matter. I published this report going back over 100 years of all the financial crises, and at the end of the day, people will flee all assets that they can to hit the bid to go liquid. And what's that liquid choice? It still is the US dollar. And people forget that even in the '08 crisis that you brought up, gold actually sold off. Now, subsequently, it did go up, but originally it sold off because people wanted to go to safety, US dollar, and then figure out where to go from there. And then they realized, hey, gold is a real currency. But if you ask the average millennial, they'll be like, gold, but I just need to buy a ring or, and the millennials get mad at me. I'm just generalizing. Generally, even my generation Xers, I guess I'm a Generation X, whatever. If you look at all the populations, I look at my brothers or my in-laws or my brother-in-law, sister-in-law, they kind of aren't buying gold. They're not thinking about, and these are good people, educated people, hardworking people. The average person isn't thinking about gold as a safe haven. So there's a lot of upside here for gold, but I think we're still in early days in the gold bull market.
Okay. You touched a little bit on negative interest rates. For the average Joe or the guy who's just starting to become awakened to things that's going on, how would you describe negative interest rates and what impact do they have on the economy?
Negative interest rates are a real-time experiment by the central bankers. And there's this fallacy, a false fallacy, where these central bankers are dumb. Central bankers are really, really smart. And the people who work there are really, really smart. And they've come up with something that I call quantum economics, which is really negative interest rates. Now, nobody truly understands what's going to happen here because this is a real-time experiment. Now, my take from all my research is negative interest rates are going to go a lot lower than everybody is saying, and they're going to stick around for a lot longer, hence why I coined the phrase FTD. Now, why? Why would anyone in their right mind give you $1 million today, and then in 10 years I'll get 950 grand back, right? That seems like counterintuitive. But you see, it's how the bond trades, Patrick. So even though the yield is negative, we've seen so many of these bonds trade at 30, 40% premium to the issue price. So the bond market, which is multiple times bigger than the stock market. That's something that, a newbie, if I want to use this new language of these millennials, a noob, and one of my cousins called me a noob because I don't know the lingo anymore. So let's use that lingo. You look at the multitude, and then you look at the derivatives market, and it's almost unfathomable, the numbers we're talking about. But these big bond fund managers, the pension funds, they're saying, okay, the bond market is a serious bubble. Now we're not investing in bonds for yield. We're actually investing in bonds for the appreciation to the value of the bond price. And that's what we're seeing. So if you think about it, well, bankers are going to do what bankers do. They're going to package up things and sell them. And there's an appetite for this now in the bond market because there's so much money that is trying to find somewhere in safety, if you want to call it safety. And look at the Austrian bond that went 0.62. It had 3 times oversold, and then the yield was negative, but the bond value was up something like 47% year to date. So this is like a bull market for a lot of these bond managers. Now, what happens in 6 years is a totally different story. But now maybe it won't be 0.6. The banker will push 0.8 or 0.9 negative, right? And rather than a 47% appreciation to the bond value, maybe it'll be 35%. And then the next banker will go junk a little bit lower, be a negative 1.5, and it'll get a 15% appreciation. So we're really in this new territory where the rules, I call it the quantum mechanics, these imaginary variables are coming in. It's just really changing the rules of economics, really. And I don't think people truly understand the implications. And people are actually accepting it because politicians are saying, well, look at what Trump's saying. Look at all his tweets. Germany's getting paid for these borrowing money. Yeah, but the average person, it's actually deflationary, Patrick. Negative interest rates, the only thing worse than inflation is deflation. Remember that. And it's deflationary because there's less money to go around. And for the same number of goods, by definition, that's deflationary. And the velocity of capital is going to slow down. That is a very, very negative thing. And the average person thinks, oh, my mortgage is going to be like negative. And they hear about these stories. But those are one-offs. The average person in the free world is not going to get a negative interest rate mortgage. You're not going to get paid to borrow money to live in a nice house that you can't afford to begin with. Like, let's really, call a spade a spade. But what's going to happen is the access to that capital isn't going to be as free, because why would I want to screw around with my capital and these low yields? I'll just sit back and be low risk and, buy this tide out. And this is a very scary thing for pension funds, people retiring, the baby boomers. This really is a transition. And you look at the valuations with the algorithms and passive funds coming in. We've never been in this territory before.
Yeah, I hear you. Completely agree with that. I've seen you mention that gold will be the number one investment of 2019. Gold has certainly had a great year so far. It's has some pretty good rallies. It's pulled back somewhat here and there, but why is gold the number one investment this year?
So for us and what I do, um, we're up over 70% year to date for 2019 in our gold sector. And so you got physical gold is one aspect. That's up about, 14, 15% year to date. That's good and fine and dandy. That's not where you're going to get the 70% gains. That's like a low risk way to play it. And for the newbies out there, there's many ways to play. You can actually just go buy physical gold, like a gold coin, gold bars, hide them, don't show them off to friends, because trust me, you're going to have people that come looking for that. Or you can buy just paper gold. That's not my favorite way to do it, but people can go that route. What I specialize in, when you build real value in my world and my experience and what I do, is companies, if you want massive leverage, companies that look for and produce gold, and that's where you get your big, big wins. Companies that drill out a major deposit that a bigger company will come and buy out at multiple prices. That's what I do. That's what I focus in, and it's been a phenomenal place to be.
Yeah, in recent months, we've also seen the gold silver ratio. It's gone up into the 90s, and we haven't seen that since the 1990s. How do you see silver, and is it just as attractive as gold as an investment?
So, that's a really important question. Let's really separate them. So there's the physical aspects,
Mhm.
and because silver is a much, much smaller market, the physical, when it does get going, you are going to see a bigger percentage increase in silver. But for me, there's this old saying: gold is the currency of kings, and silver is the currency of gentlemen. Um, I just feel that, and then they say barter is the currency of peasants, and debt is the currency of slaves. I just feel that there's fewer gentlemen in the world right now, and I'd rather be aligned with the kings. I prefer gold over silver. Some of my very, very close friends are heavily invested in silver. This world's second largest producer of silver, Pan American, the chairman and founder, Ross Beatty, is a very close friend of mine. I just think that silver is a much more industrial metal than gold. It's also much more heavily produced by byproducts. And if you look at the recycling and the way the porphyries projects are coming around and the streams on it, there essentially is no shortage of silver. And there's this whole silver bug world that hates it when I say that. But I also look at it as the uranium factor. A lot of guys hate what I say about uranium, but I've been totally spot on. And ironically, I'm one of the largest financiers in the world for the uranium sector. I just think that people have to understand, where are the mines? What currency are these mines being depleted with? So in a stronger US dollar, take uranium, for example, almost half the world's uranium comes from Kazakhstan, over half comes from the former Soviet Union. They have a massively depreciating currency. Their projects are all built with foreigners' debt, like Cameco and Areva or now Orano and all these other companies. So, and they're increasing ownership because they're in their backyard and the foreigners have no say, and you're dealing with tough Soviets. And these guys are super smart. So even though uranium's down, to the Kazakhs locally, they're kind of like the standard oil of uranium. They call the shots, and they have this cut to kill strategy. So you have to be very careful on what your time horizon is. But look, if you just position your portfolio, don't go 100% gold, don't go 100% silver either. In my portfolio, believe it or not, we're heavy cash US dollars, because I do see pullbacks. And I do believe when a pullback happens, even the best gold stocks, the best silver stocks, they all pull back also. So to take advantage of this crisis we all think will eventually happen, and these great sales, you got to have cash, because if you're fully invested, then you got to sell something else that's been significantly depreciated to buy something else that is devalued also. That's, so you got to, cash is king right now. I do believe gold is a close second. And then I would say silver is kind of a distant third.
Okay. You've touched on U.S. dollar and the dollar strength. Can you share a little bit more regarding the context of why you seem very confident of the dollar strength, and what time frame is this outlook based on?
So for me, run one of the largest funds in the sector.
Mhm.
I have to look at everything from a today perspective, and then I have up to 3-4 years in some of our investments, maybe up to 5. But when it comes to the cash management, I'm always looking at 12 months out. So I think over the next 12 months, US dollar is a pretty good place to be. Why? Well, look at just the debt globally. If you look at in my book, I wrote this book a few years ago, or maybe 5 years ago now, and I talk about how technologies are going to reverse the petrodollar. Well, the Americans used to export US dollars and import oil from the Middle East. Well, we're seeing the opposite happen now. And rather than exporting US dollars, they're exporting oil, and they're sucking out US dollars, billions a day, out of the system. That's one factor. Then you look at the debt globally, look at all the infrastructure projects. They're not done in rubles or yuan, they're actually done in US dollars, steel, cement, all of the infrastructure, that these major projects, they're done in US dollars, and that debt is paid in US dollars. Well, you're in big trouble if you have to pay your debt in US dollars, but you're making money in a local currency that's being depreciated. And the Chinese and all these different big countries, they're also very smart people, and they've set it up with their US dollars to do that, because they understand that those local currencies are never going to be as strong as the superpowers. So it's a hedge for these countries like China or Russia and all that. So those are like two quick reasons why. But if you look at the euro, as my close friend and partner Doug Casey says, the euro is who owes you. At least with the US dollar, you know who owes you, right? So you look at that, and do you want the ruble? Do you get paid in US dollars? Do you get paid, you ask yourself, what currency do you want? So I've been to over 100 countries, and it's not coincidence that the number one currency in Moscow is the $100 US dollar bill, right? There's more $100 bills in Moscow than in any city in the US, little known fact, because it's a desired currency. You go to Africa, it doesn't matter where, US dollars treated like king.
Yeah, I guess because we've been hearing a lot of talk about de-dollarization, whether it's the EU, China, Russia, and how they're developing an alternative to the SWIFT system. So with that de-dollarization seemingly on the horizon at some point, there's question as to the strength of the dollar, or even the reserve currency status. How do you see that playing out? The reserve currency status, is it eventually going to come to an end?
Eventually, like, look, the pound at one point was the currency that the whole world revolved around. These things take years and years, and the pound didn't really lose its status as the superpower until World War II, really. It had to have a major change globally. And how did that happen? Well, America was really the biggest benefactor of World War One and Two from an economic standpoint. It was financing a lot of the debts for the military and all these different aspects of infrastructure. Currencies don't change like a junior stock changes, and there's this misunderstanding that because a stock doubles in 6 weeks or goes down 50% over some results, currencies don't move like that. And I do agree with you in the long run, but not in the next 12 months.
Okay, so I'm assuming you subscribe to Brent Johnson's dollar milkshake theory.
I think Brent Johnson subscribes to my theory now. Look, Brent's a good buddy of mine. I think he's a really smart guy. He's speaking at my conference this weekend in San Francisco. But we talk all the time, and I guess the one difference that Brent and I have is I see the interest rates sticking around longer because I do the way I think about these things is, Trump is talking now about it. Like, we haven't really seen negative interest rates on the corporate side the way I think they'll get there. And Nestle did it, and I think we're going to see more of that from the pension funds, the bond market. I think this is the elephant in the room that nobody's quite figured out is there. But yeah, Brent and I are pretty aligned on that aspect. The difference is he doesn't quite play the junior or producers that I do on the mining side. He believes in gold, but he's more on the U.S. dollar side right now.
Okay. The last bull market from 2000 to 2011 saw a lot of mining companies increase their capital expenditure. They bought equipment and they also acquired new properties. When the bear market happened, many of these companies had to cut back on expenditure. Some had to close, some had to sell off mines that were not economic to operate. Can you share with us the current pulse of the gold mining industry and how they're doing with the rally in gold prices this year?
Well, look, we've had great success with our portfolio, whether it's the producers or developers. I think what everyone's kind of realized is, and where I've really pulled my portfolio is, I really don't want the political risk. And if you look at certain jurisdictions, things are just getting worse than better. Like, I believe Argentina is where money goes to die. It's just a tough place, and it's not getting better. It's getting worse. So I've kind of avoided that jurisdiction. Now, look, there's jurisdictions that may seem risky to you and I, but are a great place for the deposits. There's an old saying that God created gold, but the devil went and spread it around the world. And he kind of put the best deposits in the most screwed up places. So you got to look at yourself. But, there's also areas that, take Australia, a great mining jurisdiction. Nowhere is easy to mine. Let's get that off building a mine anywhere is difficult. But I remember in 2015 when I bought 9.9% of a company called Newmarket. They bought the Fosterville mine. And at the time, we believed and we wrote that this thing could produce somewhere between 400,000 to 600,000 ounces because we felt the previous three owners had it wrong. And I did believe in what the new management team were doing, Doug Forrester and Blaine Johnson, and we heavily got involved in that. And by just bringing in a different set of eyes, looking at it from a different perspective, and with a little bit different technology, modern technology, and taking a little bit more risk, that became the hottest story in the world. And then eventually it's Kirkland Lake, which went from $2 to $60 a share. So you see that you don't need to go in the depths of some virgin jungle and take on this crazy risk. That mine, Fosterville, in the last 10 years, is owned by 4 different owners that all took a swing at it. So think of it as like a hotel. It's usually the 4th owner that makes. So there's this fallacy that, oh, well, this project or this mine was owned by someone else, so it didn't work. Well, take Quadrilla, for example. It's Europe's largest shale company. This asset, when I came across it in 2005 and became the largest investor in the deal, it was drilled in the 70s. Well, fracking didn't exist in the 70s. The technology didn't exist. And bam, you bring in we had to build a 50,000 horsepower frac set in Canada and ship it to the UK because the rules, you can't just ship a frac set, it has to fit the parameters of the roads and all that. And they didn't have the technology or the equipment there, and that became a huge success. Take Copper Mountain. It's been a producer on and off for 100 years, and Jim O'Rourke, Hall of Famer, partner of mine, he brought modern technology to an area that's never seen this type of stuff, and we connected the pits. And, one day it's going to be one of the biggest pits in North America. So you have to look at what's going on in the region. You look at some of the big mistakes Barrick or Newmont or Goldcorp have made. It's actually interesting. If you look at why some of these projects were made, it's kind of like the Echo Bay mistake. Echo Bay got stopped running by mining engineers and accountants took over. And they put an incentive program in their companies that the more ounces you bring, you'd get a bonus. So Goldcorp and these other companies had similar type of programs. And I know of some companies, I'm not going to name names, but executives were paid bonuses for bringing in ounces. And it looked great on paper, but not all ounces are equal. So then you get all these ounces that are frankly shitty ounces, and they're not economic at $1,400 gold. And then all this money comes in, the engineers, the use of consultants, a massive capex inflation, and then delays happen, permitting delays, and the market churns. Now these projects have to be written down. So we've seen tens of billions of dollars of assets written down. Now, that doesn't mean there's certain gems in there. One we bought in 2017, Arizona. It had two different previous miners, but they did it wrong. They didn't put a crushing circuit because what they thought they were going to do is just run the saprolite, and then they would get the cash flow from that to build it. Well, rather than doing it properly, what happened was they didn't have enough saprolite on site. So I came in, scooped it up, financed it, and now it's a cash cow because of the real is at like a 15, 20-year low to the US dollar. And it's a cash cow because it's built. Our costs are in a devalued local currency, but we sell the product gold in a higher valued US dollar, right? So you get that fiscal benefit. I think that's where we're at in this market. The majors are not just going to be buying specific ounces. They want them in politically stable jurisdictions where they can see this mine being permitted, and rule of law is important. But the management teams are going to have to significantly de-risk these assets. I don't think any of the majors are going to want to take on any risk in this next 12 to 18 months.
Marin Katusa, before we wrap up, can you let our listeners know more about your work and also Katusa Research? And for the guys who are finding this very, very interesting and wanting to perhaps start off, how can they go about doing it?
I think going to conferences is a big one. I know you got to actually get out of your comfort of your home and leave the TV and the couch, but the Vancouver Resource Investment Conference that I hold with Cambridge House, that's the biggest junior mining investment conference in the world. We have 10,000 people. It's kind of like the Super Bowl of junior mining. But also just go to websites like mine. I got a ton of free research. Every week I publish something interesting on charts or, just get out there and do your own research. Look at who's who in the zoo. The only other thing I would really stress people is gold has gotten hot in the last, say, 4 or 5 months. And I've seen so many zeros try to portray themselves as heroes, and they're playing this poker game with toothpicks. Never, ever, ever follow anyone who can't own a stock that they're getting promoted. If they're getting paid to promote or they're an armchair analyst, be very careful. You want to follow guys who have serious skin in the game and also who say, hey, my cost base is $1 and the stock's trading at $1. You can get in at the same price as me. But if a guy's being kind of shady about what price he paid, or he doesn't disclose it, or he doesn't own any stock, why the hell would you ever follow that guy? You want to follow, it's Pareto's law, I call it. If you look at all of the successes in mining, believe it or not, most geologists and people in the industry have never been involved in a success. Well, there's patterns to success and there's patterns to failure. And just like every other sector in the world, Pareto's law applies to mining and investing. And 80% of the successes and discoveries are really within the 20%. Now, there's thousands of companies. That's still a lot of companies to analyze. Well, start with the people. The people is the most important aspect. Now, you take that first 20 of 80, and then you go again within that population base. Pareto's law, the 20 and 20. So you got 4% of the 80 of 80 is 64. So you find out that, 2/3 essentially of all the successes are within 4% of the people. And that's who you want to focus on. Now, granted, you may miss a third of the big wins, but you don't have to focus on 96% of the people, which is a lot of companies. Focus on just the best who have skin in the game, and you're aligning yourself in this stage of the market. You don't need to pay a big promo from what the insiders. You can pay prices at the same price as the guys who've put millions of dollars into these assets. That's where someone who's starting out should start looking at. People spend time on trying to study the gold market and all these different things. If you're playing the equity, the actual publicly listed companies, what I just talked about, start with the people, the cost base, and their track record. That's where you want to start.
Yeah, that's some terrific advice there. Really appreciate that. Uh, Final question though. What have you done today to be better than Rick Rule?
Rick Rule is an old good friend of mine, and every day is a challenge to be better than Rick Rule. Well, we're actually doing a financing right now that he requested 3-year warrants, and I got the Katusa warrant, which was a 5-year warrant. So that was the last thing I'd done better than Rick Rule. And Rick's so good that he's a benefactor of that too. So he's benefiting from that extra 2 years in the warrant. So we work together very closely. At times we compete, but he's a legend in the business. And something you may not know, I have the honor of giving the talk to induct him into the Resource Hall of Fame in January. So that's been a great honor for me. And he's just been such a great mentor, friend, just a wealth of knowledge and experience. And he doesn't slow down. What I love about Rick is it's not about the money. It's about the thrill. It's about making money for his investors, his clients. And he's the second best stock picker in the sector.
Yeah, and he's also got the best selection of helmets up on that cabinet, also, huh?
There you go.
Yeah, but I tell you what, I've really had the pleasure to talk to all the members of KCR, Katusa, Casey, and Rule, and all three of you are some pretty incredible people, and I do hope that our viewers do take the time to look more into what you do and give you that trust, because you guys definitely know what you're doing there. Pretty awesome.
It's hard, and you know what? We still make mistakes, and we still learn every day. This game is a very complicated industry, and one thing that I've learned at this stage of my career is you can put something into production, and you can have the best engineers, the best bankable feasibility study, the best experienced guys, and anything and everything that could go wrong will go wrong, and you have to be prepared, and the key is to be able to adapt and solve problems. Really, our industry is about solving problems.
Okay, there you go. Marin Katusa, we appreciate your time, and we do hope we can do this again, and we wish you all the best.
Thank you. It's my pleasure. Have a good one.
That was Marin Katusa, founder of Katusa Research, sharing his outlook of the economy and gold. To find out more about Marin's views, please visit KatusaResearch.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.